All right, guys, how's it going today? Today, I want to go over how to avoid the pattern day trading rule, right? So, um, some of you might know, some of you might not, but, basically the pattern day trading rule limits how many day trades you can make if you have under $25,000 in your trading account, right? Which not everyone has, right? So, to me, it's a bullcrap rule. And it's just another way for big money to steal money from small money, right? But we're a little bit smarter than that, right? We can work our way around that by a couple of different tricks, right? And that's using, different options legs or legging into option spreads, right? So let's go over this here. I'm going to use Facebook as an example here. And, some of these numbers are not 100% accurate. They're kind of more of an approximation, but I did actually go over the options chain. So the prices aren't outrageously far off. But let's take Facebook for an example. Okay. So currently, Facebook is at $210. Okay. And let's say you are bullish for this week. So you buy the March 4th 220 strike calls for 125 each. Okay. And then Facebook moves up in your favor. So you end up being right? And it moves up to, let's say, 215. Okay. Now, those 220 strike calls are going for about $300, okay? And, it's about this time that you're thinking to yourself, like, ah, crap, I'm out of day trades. What am I supposed to do? I just have to hold on to it and hope that it stays up and doesn't, have a big pullback by tomorrow before, when I can sell it. So, you're like, well, what can I do about that? So what you can do is you can slap a short call on it, right? So next bullet point, you're out of day trades, and you can't sell to lock in your more than 100% gain. Okay, so normally you would have to hold on to it and hope it holds its gains into tomorrow. Okay, oh come on, let's go back down here. Okay, I can check these boxes as we go, actually. So one option you can do to lock in and protect your gains is to sell a higher strike call against that call. Okay. So after Facebook moves up to 215, that 225 strike call ends up going for about $200. Okay. So you can sell those on top of the 220 strike calls that you already have. And what you're doing here is you're basically creating the 220 by 225 debit spread. Okay. So by selling the 225 calls for $200, and since you already paid 125 for the 220 calls, then you are locking in a minimum of $75 profit, no matter what happens, okay? So this is called, like I said earlier, legging into a debit spread, okay? So you've just legged into the 220 by 225 call debit spread, okay? So now, no matter what happens, no matter what happens, you make $75, even if Facebook tanks to 100 somehow, right? But if Facebook moves up and stays above 225 and keeps going up, then you stand to make $575, okay? Now, that's the maximum you can make from here on out, though. That is the downside, but $575 is still a good amount of money, right? So, don't get greedy and, well, I don't want to limit my potential upside or anything like that. Because more times than not, the stock isn't going to rocket up to, 240 from 220 or from 210, right? In which case, yeah, you're leaving a couple $1,000 or so on the table. But, walking away with $575 is still a really good deal. And you should be happy with it, right? Because like I said, more times than not, you aren't going to see a move like that, okay? That's going to happen maybe 10 to 20% of the time, right? And it's just not worth the extra risk to me, in my opinion, okay? Now, so to calculate this, how I got the max profit on that. So it's simply the difference between the initial debit paid for the long call and the premium collected for selling the short call, right? So that was 125 and 200, right? So 200 minus 125 is 75, plus the width of the strikes, which is 5 in this scenario. So 225 minus 200 is 5. So 5 plus 75 gives me that 575 for calculating what the max profit is, okay? So you can actually take this a step further too and add a call credit spread after it runs up even more, okay? And I do this all the time, and honestly, it works really well for me. It's one of my better, more consistently profitable strategies that I use with options. It's just, sure, I've missed out on some big gains before, but I've also protected myself from bigger losses before too. And there's a couple of times where in this situation, I actually get like, a quote unquote lottery ticket win, right? And I'm going to go back here in a second. So let's say Facebook continues to run to 220 on the same day, right? So you still can't sell anything, right? So what you can do then is you can sell the 225 by 230 call credit spread on top of it also. Okay, so that means you're selling the 225 call and then buying the 230 call, right? So this is an equal, balanced, regular butterfly, okay, that you're legging into, because the 220 and 225 is 5 wide, and the 225 and 230 is 5 wide, okay? And you would likely collect about $175 in credit on this particular setup, okay? On that particular call credit spread, okay? So now, no matter what happens, we will make $250 even if Facebook tanks, right? Because we've already collected 175. We've collected 175 on the credit on the call credit spread, and then we've collected 175 on the initial debit spread that we've legged into, right? So because we've collected 175 in the credit on the call credit spread and 200 on the 225 short call and only spent 125 on the initial long call, you've got 175 from the call credit spread, 200 in premium from the 225 short call, minus the 125 debit that we paid for the 220 call. That gives you $250, okay? Now, in this instance, when I've legged into a butterfly like this, what I'm normally going to do is I'm likely going to hold it until the day of expiration. And this is what I was talking about with that potential lottery ticket win, okay? Because if we get lucky and Facebook pins 225, then we make $750, okay? So you get 575 from the max gain on the initial call debit spread that we legged into, and then the 175 from the credit spread, okay? So not a bad deal, right? So this, like I said earlier, is what's called legging into a butterfly spread, okay? And this is just one way to do it, right? Like this is just one variation of an example like this. So you can structure this as however you want, right? You can add whatever short strike you want on there. You can choose not to add a credit spread on top of it, or you can vary the width of the credit spread that you're adding on there. You can pick, instead of doing 225 short call, you can do 222 short call. You can do 230 short call, right? So depending on how conservative you want to be or how bullish you are, will determine what your approach will be, okay? So if you aren't that bullish or expect price to reverse sharply from the target, then you can turn that naked long call directly into a butterfly instead of a debit spread, okay? So basically, you can do this by adding what's called a ratio spread. So you would sell 2 of the 225 strike calls and then buy a 230 strike call on top of the naked long 220 strike call. Okay. And then this ratio spread would likely go for about 300. Okay, so you'd collect a 300 credit in that. So here you are locking in a $175 profit. Okay, and this makes your potential max profit 675. Okay, which is less than if you legged into the butterfly, but also locks in a higher guaranteed profit if Facebook tanks. And it's also more than if you just slapped on the 225 call debit spread and it tanked, right? Because in that, or the max profit on that is 575, right? So this is an additional $100 profit if it hits that 225 mark. Okay. If you're more bullish on Facebook and you think it's going to go a lot higher, then you can wait a little bit longer and you can add a short strike that is higher up, okay? Such as, let's say, the 230 strike call instead of the 225 short call, okay? So now you've legged into a 220 by 230 call debit spread, okay? Then, oh, come on, man. Why does this keep happening? There you go. Bro, go away. All right, man. I guess we can't check this box anymore. Okay. So then from here, you have a few more options depending on how bullish you are, okay? If you are extremely bullish, then you just leave it alone and you let it run and you stand to potentially make $1,000, okay? Assuming that you collect 125 on the 230 short call, right? Because the initial debit you paid for the 220 is 125, and if you collect 125 on the premium, then those cancel out to zero, and then you find the max profit by doing the width between the two strikes. So 230 minus 220 is 10.00. That's $1,000. Okay. If you are a little less bullish than that, then you can add a 230 by 235 call credit spread on top of that, right? So you've legged into the 220 by 230 debit spread, but you're starting to lose a little bit of your bullishness, but you're still fairly bullish and think there's a chance that it could keep going to 230 or higher, okay? So you would add the 230 by 235 call credit spread to it, okay? And this is called legging into a broken wing butterfly with no upside risk, okay? So if you added the 230 for 125 and then added the call credit spread for $100 credit, then you make $100 minimum in this situation if Facebook decides to tank, okay? If Facebook pins 230, then you make $1,100, okay? If Facebook blows past 235, then you still make $600, okay? Because you'll make $1,000 on the call debit spread, and then you'll lose 400 on the call credit spread, right? So 1,000 minus 400 equals 600. Okay. If you're less bullish than that in the above scenario, then you can leg into a balanced or regular fly and sell the 230 by 240 call credit spread, which let's say is a $200 credit. Okay. So now, no matter what happens, you make $200, okay? But you have a potential to make $1,200 max profit, okay? But if Facebook somehow blows way above 240, which, the odds of that happening are pretty low, but if it happens, then you only make $200, right? Because you make $1,000 on the call debit spread, but you lose 800 on that call credit spread that you added, okay? And this has happened to me before with Amazon, Roku, high-flying names like that. It is what it is, but at the end of the day, you can't beat yourself up too much about it because you still made money, right? So anytime you're walking on a green, don't complain. So if you're even less bullish than that, then and think Facebook potentially reverses hard from where it's at now, then you can leg into a broken wing butterfly with upside risk, right? So you could sell a 15 wide credit spread, right? So you would sell, say, the 230 by 245 call credit spread, which let's say is about $400 credit, right? So now in this situation, you've locked in $400 profit, okay, even if Facebook tanks, okay? If Facebook pins to 30, you make $1,400, right? So this is the highest max profit that we've talked about in this in all of these examples, right? So that's pretty good. And again, we're talking about moving 210 to 230, which is a pretty crazy move, okay? It's certainly possible for it to blow way above 230 and above 245, but again, I don't see it very likely, right? So this to me is still a pretty low risk strategy, okay? But this play, like I said, does have upside risk, okay? So if Facebook somehow runs way past 245, then you will lose $1,100 on the call credit spread, but make $1,000 on the call debit spread, okay? So you lose $100 total on the play, which, keep in mind, is still less than the initial debit that you paid for that initial 220 strike call, okay? So this is still even less loss potential than the original play that you even entered into, right? So to me, it's kind of a no-brainer, especially if we're hitting resistance, right? Like if there's strong resistance at 230, I'm probably going to add this, right? And I've had this happen before where it does end up pinning that strike, right? And I've turned, an initial $100 investment into $1,500 before, right? Like a 15x move, which is not easy to do, right? But it's very possible with butterflies and legging into butterflies especially. Okay, so I just want to make you guys aware of these possibilities, right? So you can use, so as you can see, there's a multiple different approaches, multiple different techniques and ways to approach this depending on your assumption and where price goes next, okay, and how bullish you are, right? To me, the key is to never be too greedy with these setups, okay? Never, just assume like it's just going to keep going up. What if it keeps going up, right? Okay, so if it does go up, like in most of these scenarios, you still make money even if it does keep going up, okay? But one key thing I always try to aim for in this strategy is covering the initial debit paid at least, okay? So that might mean adding a lower strike short call on, or adding one sooner than I intend or before the stock reaches my intended target. Hi, buddy. My dog's coming to see what I'm doing. Hi, buddy. I'm almost done. So, if you grab that 220 and, you were planning on grabbing the 230, but it's looking like it might stall and might reverse down, maybe grab that 225 instead and cover that initial debit that you paid, just in case Facebook doesn't keep moving up. But if it does keep moving up, then you still make $500, right? Which again, like that's a good gain for most people. $500 is a good gain, right? And if you have under a $25,000 account, $500 is a good gain for you, right? So you should be happy with that with under a $25,000 account, okay? That pretty much covers most of the general gist of this strategy that I use. So, if you guys have any questions on this strategy, please head on over to the Discord and, ask me any questions. I do, like I said, I do this strategy all the time. So, if you are interested in implementing something like this and just, want to start trying it out on your own and you just want to ask me about it in real time, definitely head over to the Discord and, just ask me my thoughts on what I think of you doing this or that, right? But yeah, that's all I have for you guys, and I hope you guys have a good weekend and take care. All right.